Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio and cut right through the market weakness. I'm your lead analyst. So today we are not just looking at another ticker symbol on a screen. No. Today we are putting on our hard hats and we are stress testing a fortress. We're talking about Charter Communications, an absolute titan of American connectivity, a company that was literally built to last for decades. But you know, every fortress, no matter how big, no matter how strong, eventually faces a siege. And right now, the walls of Charter's castle are being battered. The foundation is showing some serious signs of stress. So the question for every single investor out there is simple and it's brutal. Is management forging a brand new, stronger foundation that's actually capable of withstanding this attack? Or are we just watching the very first cracks of a total, catastrophic collapse? Let's get into it.
Now here's the thing, you don't have to take my word for any of this. This isn't just some analyst speculation or Wall Street rumor. This is coming straight from the horse's mouth. This is a direct quote from the man at the very top, CEO Christopher Winfrey himself. I mean, think about it. This is the general of the army standing on the battlements, and he's admitting for everyone to hear that the enemy isn't just at the gates, they are attacking from every conceivable direction. He's talking about low move rates. What does that mean? It means people aren't moving houses as much, and for a cable company, that's a huge driver of new internet signups. Fewer moves means a stagnant pond to fish in. Then he says mobile substitution. That's people just saying, you know what, my phone's hotspot is good enough, and ditching home internet entirely. And then he explicitly names the siege engines hammering his walls, cell phone internet competition, and the relentless creeping growth of fiber. This is an unbelievably clear-eyed admission that their core business, the very heart of their kingdom, is under a massive multi-front assault.
And this is the first casualty report from the front lines. A hard, cold number that tells you without a doubt the siege is working. In the fourth quarter of 2025 alone, Charter lost 119,000 internet customers. Just let that sink in for a second. Their main product, their flagship service, the high-margin broadband that pays for literally everything else, it's bleeding subscribers. This is not a slowdown in growth. This is a full-blown retreat. For a company that was built on the entire premise of being the essential internet provider for millions of Americans, a number like this represents a major breach in their primary defense. The moat has been crossed, and the outer wall is officially damaged.
And you better believe that a breach like that has an immediate financial cost. Losing that many high-value customers translates directly into a 2.3% year-over-year decline in their fourth quarter revenue. The top line is actually shrinking. Money is flowing out of the fortress, not in. Now, for a mature behemoth like Charter, any kind of decline is a big red flag, but a drop of this magnitude, it demands our full and undivided attention.
Okay, hang on. Let's pump the brakes here for a second. 100,000 customers, a couple of percentage points of revenue. I mean, for a company this massive, is that really a flesh wound, or are we talking about a mortal blow? What I'm really asking is, are these just the first few cracks you'd expect to see under immense pressure, or is this the beginning of a total structural collapse for this cable giant? Because let's be honest, we've seen this exact movie before with legacy tech companies.
You know what? That is the exact question we have to answer. And before we can even begin to assess management's grand plan to rebuild, we have to do our due diligence. We have to survey the full extent of the damage. See, a single bad report can be an anomaly, a fluke, but we need to know if this is just a cosmetic crack or if the entire foundation is rotten to the core. So let's look at the trend. We need to walk the entire perimeter of this fortress, map out every single weakness, and understand exactly how deep the erosion in this foundation really goes.
So just look at this table. It lays it all out with brutal, undeniable clarity. What you're seeing here are the net losses in total customer relationships. That's the broadest possible measure of their customer base. And the really crucial point here is that this isn't a one-off bad quarter. Just look at the trend across the entire fiscal year of 2025. They were down 54,000 in Q1, then down another 100,000 in Q2. It continues, down 87,000 in Q3. And it was all capped off by that 127,000 loss in Q4. You see, this isn't a single breach in the wall. This is a persistent, year-long erosion. The fortress is losing its citizens every single quarter, without fail. This isn't a battle. This is a grueling war of attrition. And as of right now, Charter is losing.
Okay, and if we isolate the high-margin internet business, I mean, this is the engine room of the whole operation, the picture actually gets even worse. Look at this trend right here. These aren't just any customers leaving. These are their most profitable customers. These are the people who pay for the entire enterprise. The damage isn't just wide, it's deep, and it's targeting the most critical part of the entire structure.
For Charter, losing internet subscribers is like a castle losing its food supply. Sure, you can hold out for a little while on your reserves, but eventually the entire system begins to starve. The trend is absolutely undeniable, and it shows the damage is deep, it's sustained, and it's getting worse.
And it's not like it's a huge mystery why these numbers are falling off a cliff. The CEO basically spelled it out for us. The attackers are at the gate, and they've got powerful new weapons. First, we're talking about aggressive fiber companies literally laying down superior technology right on top of Charter's territory, offering faster, more reliable connections. And then you've got the big telecom giants deploying what's called fixed wireless access, which is basically just using their powerful 5G cell networks to beam home internet into your house. That's a brand new competitive threat that didn't even exist a few years ago. These are the battering rams. For decades, Charter had a comfortable local monopoly, or at best, a duopoly. Well, that world is over. They are now in a bloody street fight for every single customer, and their old copper and coax technology is starting to look like a stone wall trying to stop a cannonball.
Exactly. The old defenses are crumbling. The core business is clearly under siege. The situation, let's be honest, it looks pretty dire. But this is where the story pivots. This is where management strategy really comes into play. They see the damage. They absolutely understand the threat. And instead of just trying to patch the old crumbling walls, they are bringing in entirely new, fast-moving reinforcements. They are betting the entire future of the company on a completely different kind of army, their mobile business.
Okay, now look at this chart. This is the counter-narrative. This is the other side of the story. While the internet business was bleeding hundreds of thousands of subscribers, the mobile division was putting up absolutely massive numbers. We're talking 428,000 new mobile lines in Q4 2025 alone, nearly 500,000 in Q2. Now, this isn't just some nice organic growth. This is a strategic weapon. Charter is leveraging its existing customer relationships to aggressively bundle mobile service, creating a really powerful counterattack. For the full fiscal year of 2025, they added an incredible 1.9 million mobile lines. This isn't just growth, it's an explosion. This is the brand new engine they are bolting onto the side of their legacy business, and right now, it is firing on all cylinders. This is the reinforcement army arriving on the battlefield just in the nick of time.
Let's just put this into a stark comparison, because this right here, this is the entire bull case for Charter on a single slide. On the left, you've got the problem, a net loss of 119,000 internet customers in the fourth quarter. It's ugly. But on the right, you have management's all-in bet on the solution, a net gain of 428,000 mobile lines in the very same 3-month period. Think about that. For every single high-value internet customer that walked out the door, Charter convinced nearly 4 people to sign up for a mobile plan. The strategy couldn't be clearer. Use the powerful high-growth mobile business to offset the decay in the core business and hopefully create a new, converged, sticky customer that's much harder to lose.
But that brings up the real billion-dollar question, doesn't it? I mean, adding all these mobile lines, it looks great on a chart, but is this a real, honest-to-God, load-bearing pillar that can actually support the entire weight of this company? Or is it just a cosmetic fix, a fresh coat of paint on a rotting structure? We know that these mobile plans are often really low margin. They're bundled as a way to keep people from leaving their high-margin internet service. So is this new reinforcement army a legion of elite, profitable soldiers? Or is it a peasant militia that looks good in a parade but can't actually win the war? Is this mobile growth profitable enough to actually patch the gaping hole being left by the decline in broadband? Because if it isn't, then all of this is just a fancy distraction from the core rot.
That is the risk. And you know what? Management has a long-term answer for it. They argue that this isn't just about plugging holes in the wall. No, it's about a complete teardown and rebuild of the company's entire financial structure and its network capabilities. They've laid out this incredibly ambitious, multi-billion-dollar blueprint for the future. It involves an immense amount of heavy lifting and peak spending right now, all for a promised massive payoff in free cash flow a few years down the road. So let's take a closer look and examine that blueprint.
This slide, this visualizes management's entire long-term game plan. Peak spending now for way higher cash flow later. They are pouring billions, a staggering $11.7 billion in 2025 alone, into upgrading their network, extending their footprint, and basically preparing for the next decade of brutal competition. The whole idea is to front-load all the painful, expensive work. It's like they're telling investors, look, endure this period of heavy investment with us, because once this rebuild is complete, that spending is going to drop off a cliff, and when it does, it's going to unlock a torrent of free cash flow that can be returned directly to you, the shareholders. It's a huge bet on the future.
And this right here, this breaks that entire blueprint down into 4 very clear steps. This is their explicit fortification plan. Step 1, Peak capital expenditures. Spend the money. Spend it big right now in 2025 and 2026 to get all the hard work done. Step 2, complete the network evolution. By 2027, they plan to have multi-gig symmetrical speeds, and what that means is your upload speed is just as fast as your download speed, available across their entire footprint. That would basically neutralize the main advantage that fiber has over them today. Step 3, normalize CapEx. Once the upgrade is done, bring that spending way down to a sustainable, normal level. And then the payoff. Step 4, unlock free cash flow. With all the heavy spending behind them, they plan to generate massive amounts of cash. It's a clear, it's a logical, but it's an incredibly expensive plan. And, well, a plan is only as good as your ability to pay for it.
Yeah, it's logical if you have infinite money and infinite time, but they don't have either. And that very expensive plan introduces an absolutely immense risk. You can't just talk about a multi-billion-dollar rebuild without talking about how in the world they're paying for it. And that pivots us right to the single biggest weight on this entire structure, the enormous, frankly terrifying mountain of debt that this company is carrying on its back. This is the structural load that could cause the entire thing to collapse long before they even get to step 4.
And here is the size of that mountain. As of the end of the fourth quarter, Charter is carrying $94.6 billion in total principal debt. With a B. Let's be crystal clear about what this number really means. This is the immense, non-negotiable structural load that every single part of this business, the decaying old internet business and the new growing mobile business, has to support. Every single dollar of profit, every new subscriber, every cost they cut has to first go to servicing this colossal weight. It's a constant, crushing pressure on the entire enterprise 24/7.
And this number, this is how Wall Street measures that pressure. It's called the net debt to EBITDA ratio. And at 4.15 times, Charter is significantly leveraged. This metric essentially says that if they took every single penny of pre-tax earnings and used it only to pay back debt, it would still take them over 4 years to pay it all off. Now, this isn't just a number on a spreadsheet. It's a measure of risk. With this much leverage, there is very, very little room for error. If the internet business declines faster than expected, or the mobile business turns out to be less profitable, or that big CapEx plan goes over budget, this debt load can become an anchor that pulls the entire company right under the water. It amplifies every mistake and turns every little headwind into a potential hurricane.
So, that brings us to the final judgment. We've surveyed the damage to the core business. We've seen the new mobile reinforcements storming the field. We've reviewed the blueprint for the big rebuild, and we have measured the mountain of debt that it's all built upon. Now it's time to weigh the structural weaknesses against the structural strengths and deliver the official iron financial verdict. Is Charter Communications a solid investment opportunity, a fortress being rebuilt stronger than ever before? Or is it a classic value trap, a decaying structure that's about to collapse under its own immense weight?
Look, on the one hand, you have to respect the strengths here. You have explosive, consistent mobile growth that is bringing new customers into the ecosystem every single quarter. You have a clear, credible, multi-year plan to slash capital spending and unlock a massive amount of free cash flow, which could mean huge stock buybacks or even dividends down the line. They are being incredibly aggressive in upgrading their network to compete head-on with fiber, and management is guiding for a return to EBITDA growth in 2026. If you believe in this plan, you're buying into a company at the moment of peak pain, right before the financial rewards of their heavy investment begin to materialize. It is a classic turnaround play.
I gotta say, I see a very, very different picture. I look at the weaknesses and I see a classic value trap. You have persistent, undeniable customer losses in your single most profitable business. You have intense, ever-growing competition from what are, frankly, superior technologies. You have a nearly $100 billion debt load that magnifies every single risk, and you have declining revenue and EBITDA right now, today, not some projection for the future. The bull case requires you to believe in a perfect execution of a very expensive plan, all while the core business is actively on fire. To me, this looks less like a fortress being rebuilt and more like a beautiful blueprint for a castle that will never get built because the foundation has already crumbled into dust.
And in the end, that is the question that you have to answer. The entire investment thesis for this company comes down to this single, crucial conflict. Charter has essentially strapped a powerful brand new mobile jet engine onto an old, heavy, and indebted airframe that is clearly losing altitude. So as you go out there to forge your own portfolio, you have to decide, is that new engine powerful enough to stop the descent, overcome the immense structural weight of nearly $95 billion in debt, and actually carry this entire company to new heights? Or will the dead weight of the legacy business and its mountain of debt overwhelm that new engine, sending the whole thing into a terminal decline? The potential reward, if they pull it off, is significant, but the risk of a total collapse is just as real. The choice, as always, is yours.